Next one up here, Magnificent Seven should be renamed the Fantastic Four.
I mean, it should be rebranded the Fantastic Four. On that list, Meta, Amazon, Microsoft, and Nvidia. That stock pointed more gains in the pre-market this morning. This after a 16% spike yesterday, juicing markets all around the world. Joining us right now, Dan Niles, founder and senior portfolio manager of the Satori Fund. Good morning to you. I was going with the Fancy Four. Fancy Four, we like.
I like the word fancy.
Well, I'm a superhero fan, so I had to go with the Fantastic Four. So what can I tell you?
I hear you. But why don't you just explain why you're taking three off the list? I'm curious about, actually.
Well, I think if you look at the last 2 years, really stock prices were driven by the Fed. So you go back to 2022, the Fantastic or the Magnificent Seven, as they called them, were down 46% during that period of time. And that was because we had the fastest rate hikes in history, had very little to do with earnings. You go back to last year, the Magnificent Seven were up 111% over that same period of time. Again, not really earnings driven. Every stock went up because Fed was on hold. People were at one point expecting up to 7 rate cuts. And so multiples expanded across the board and stocks ripped. Right now, where you are is earnings seem to be driving a differentiation among these names. So Apple, after they reported their December quarter, estimates went down again from March. For Tesla, similar situation. And if you look at Google in that group, they did well in their AI-related business, Google Cloud, but their big business, which is search, which is what they're known for, and YouTube, both of those categories missed. Meanwhile, you had Meta blowing out numbers. If you look at those three that I dropped off the list, that's what they all have in common. The earnings are struggling. They're having issues with competition. And I think you're seeing that in the stock prices where Apple, Tesla are both down this year. Google's underperforming the market. And then the Fantastic Four are absolutely doing great because the numbers for 3 of the 4 went up a ton. And, Microsoft, obviously, ChatGPT, they own 49% of OpenAI, massive benefit for that for them. So that's why we've dropped those 3 off the list. It's competition issues.
Okay, so of the Fantastic or Fancy Four, as we're going to call them here on Squawk, which one do you like the most? You're only allowed to own one.
Ooh, good question.
If I had to own one just from a risk-reward basis, I'd probably go with Meta. It was my top pick, one of my top 5 picks last year. The stock, obviously tripled last year, almost tripled. And if you look at it this year, it's also doing well. And the reason why I like it is they're using AI to help drive content recommendations so people are more engaged with the platform. They're using it to drive better ad monetization. And if you think about this year, your segment before was talking about the election coming up. It's going to be the most hotly contested election we've ever seen with tons of advertising. And that's really going to benefit Meta during that period of time as well. And it's growing high teens, but you can buy it at a 24 PE.
Yep.
The entire market's trading at, the S&P is trading at 21 times. So it's got this great combination of low valuation, fast growth, and a presidential election that's a nice kicker towards the end of the year. And so that's why that's probably my top pick.
Preach.
What do you think of Nvidia? I mean, some people think that this has so much more room to run, and others say it has run too far.
Well, there's a time element and a multiple element to this. So if you go back to the tech bubble, which we all lived through, Cisco at the time was the most valuable company in the world. Nvidia is now the 3rd most valuable company. But during the peak of that bubble, Cisco was growing revenues close to 60%, but it had a PE of 138 times. Nvidia grew revenues at just over 100% last year, forecasted to grow 90% this year. Cisco peaked at 138 times. Nvidia's at 35 times. There's a whole group of semiconductor companies that actually have higher PE ratios than Nvidia does, believe it or not. So, and Nvidia is enabling the AI revolution. And don't forget, we never even heard of ChatGPT until November of 2022. That tech bubble, you could argue, started in 1995 when this new thing called the internet, what's that, showed up.
AOL,
and it
baby.
took 5 years for you to actually build to that
Windows
peak.
95.
So this is a year and a quarter or so since ChatGPT showed up. I think you have a long more way to go before you kind of get to that peak level of euphoria, if you want to call it that, because we're nowhere near that yet.
What about Google?
So the more quarters NVIDIA puts up, the harder it's going to be for, and I think it's important everybody understands this point I'm about to make. Listen, NVIDIA has destroyed numbers several quarters in a row now at this point in time, right? The more quarters this story goes on and they keep beating their past quarter and they keep guiding up, right? The more people are going to doubt, like, the downfall of NVIDIA, essentially, right? And the more they just keep coming in, beating. At some point in time, maybe numbers start to flatline, but you're still maybe looking at 1 to 2 years before numbers flatline in regards to NVIDIA. Like, it's still a bit of time to play out here. And so in this next 1 to 2 years, it's just like, man, it's hard not to jump on that bandwagon, right? And so the whole downfall of NVIDIA, at some point, I'm sure the stock will get hit hard and it will come down huge, but you still might be 1 to 2 years away from that. And in that time period, NVIDIA could climb to $1,500+ between now and then. So that's just what you got to keep in mind.
That's the one that I want to get long. We're short it right now because I look at Google and I go, everybody's sort of written them off in this AI race, but they have more data than anyone. The problem is they have this cash cow called search that they're trying to defend. The problem is things like ChatGPT are growing incredibly rapidly, and a lot of people are using that for conversational results instead of tapping through 10 blue links to try to find what you want. You could interact with an AI, and then that'll tell you what hotel you want by talking to you and asking you, hey, do you like a gym? Do you want a 4-star restaurant? And then it'll tell you, well, this is what you should pick. And so I think that's the issue Google has right now and on the YouTube front, things like Amazon launching ads on Prime, that's taking a lot of ad revenue that would have gone to YouTube, or ads on Netflix, ads on Disney. But they also are going to benefit from a presidential election. So that's the one trading at a market multiple that if they can kind of decide, all right, we're going to go all in on AI and, we'll deal with the fact it may kill off some of our search revenues, that's when it gets really exciting, because that's the one that's a market multiple but has a huge amount of training data to train AI models. So we'll see what happens there.
Okay.
Yeah, so I thought those were bad examples Dan Niles gave there in regards to the whole Google thing. Like, I'm not going to ChatGPT to find out the best restaurant to eat at tonight. No, okay? I'm still using Google for that. Or I'll use Yelp or something like that, or to look up hotels or things like that. I'm not using freaking ChatGPT, and I don't know anybody that would. Like, you would have to be delusional to use ChatGPT for those sorts of things over Google. No, you're not doing that, right? And so I thought that was a bad example. There's a lot of research purposes you might use ChatGPT, academic-related folks, they might use it over Google. But for a lot of these commerce-related things, the things that actually generate money, right, that get clicks and somebody has to pay for that ad and things like that, Google's still the crown jewel there, and they're going to be the crown jewel for years to go in the future. I mean, that's just the way it is. I don't know any other way to put it other than that. That fear around that is kind of a little bit irrational in my personal opinion, okay? Anthony Noto was interviewed by Kathy Wood here, and I think this is an interview that everybody should see. I want to share my opinions and perspectives and point out some big things that were talked about here in this interview. In the back half of it specifically, that's when it seems to get much more interesting. All right, so let's get into this.
Two of the largest banks in our country go out of business, both in California, both technology oriented. I mean, Hank Paulson used to say, your house and your street is only going to be worth what the other houses on your street are. And so to be in California, in the same region as these other two banks, technology oriented, it definitely raised the level of scrutiny and the level of care that we have to bring to the table every day. And the team's done a great job navigating it, but it's definitely was absolutely not expected.
We're still seeing demand deposits leave the banking system. Has the psychology shifted from scrutiny to more trust? And are you actually becoming a beneficiary of this?
We've been a beneficiary, but not because of anything other than the design of our product. And, in fintech, there's not a lot of talk about product design and product market fit and the application experience, but those are huge differentiators for us. And I'm actually glad no one talks about it because they don't understand how important it is. But we architected our digital wallet, or the equivalent of a checking savings account, SoFi Money. We architected it such that the value you get will only be unlocked if you're willing to make us your primary account. i.e. do direct deposit with us. So our 4.6% interest is really high, but you only get that if you do direct deposit. You also get no fees, you get reward points, you get a free certified financial planner, you can pay your bills any way you want.
Okay, so this is a huge point right off the bat here. Okay, so I was considering moving a substantial amount of money to SoFi to earn that interest rate, right? But they do not allow you to get that 4.6% or anywhere remotely close to it unless you have direct deposit set up, okay? So this is good and this is bad. One, it obviously encourages people to have direct deposit and, so they can get that 4.6%. That's good. And you want to, the holy grail is always having that direct deposit being the main banking, product for folks out there, right? But the problem here, and this is, it is a problem, okay? Guess what? Now they can't win me over personally as a customer, right? Think about it. If instead I'm going to do my business with Goldman Sachs, I'm going to do my business with Ally, Chase, and others, because I want my, a 4% plus number, because I can get that from several other institutions. Can't get it from Chase. I can actually get a 5% number from Chase if I do a 2-month CD, because if you're in like the private wealth thing, you get like 5% 2-month CD, and you can kind of just keep, renewing that. But the issue is they're not even going to be able to get a relationship with me, right? If they had offer something like that, let's say, okay, you can also get 4.6%, not just with direct deposit, but let's say you deposit $100,000 in, something like that, right? A lump sum. Okay, then we can build a relationship and then they can sell me other products and services over time. But by not at least offering that, that creates a, dynamic where you're not going to build a relationship at all, right?
Mobile, upload a check. We give you access to your capital faster and quicker than most firms would because we have all the information on you. And so as these events started to happen, we were able to show our board, to show the regulators, the efficacy of our design. 90% of our deposits are direct deposit customers, which means they're sticky. It's not just hot money chasing an interest rate. And then 97% of them are insured. We provide $2 million of insurance through a separate program. We partner with somebody on top of the $250,000 that we are able to provide through FDIC insurance. So we supplement that through a partnership. So it actually amplified our differentiation in a way that we couldn't have paid for. And so we've had, more than $2 billion of new deposits each quarter, and the value prop is really compelling. And we continue to see the flywheel work in incredible ways, and people cross-buying to other products and driving down marketing efficiencies, et cetera.
And Andrew can talk a little bit more about this than I can, but because of the way you measure success, you use this concept of members, and as opposed to another concept, whether it's MAUs, DAUs, what have you. I think it's been a little bit difficult to break through to the financial community that only knows how to analyze using that lens. Andrew, would you say it any differently? I'd love to hear a little bit about that journey and why you decided to take it. Is that right, Andrew? Did I characterize?
I was really skeptical when I first started modeling SoFi, and I wanted to just look at app MAUs, for example, but the correlation was so much stronger on a total members basis with respect to like revenue growth than it was for these active members. Must mean that the lifetime is just so much longer on SoFi than I guess how we traditionally view consumer apps. Maybe Anthony, could you give us more color there?
Yeah.
Okay, let me put it real simple. Okay, listen. SoFi's a bank. It's a bank. It is a very fast-growing bank, but it is a bank. It's an online bank, okay? Let's not confuse us, And banks have very strong long-term relationships with their customers. That's what the banking
I lived in the social media world at Twitter, and I covered, Facebook and as a banker and other companies that used MAUs and DAUs. And when I joined the company and we were talking about our metrics, I said, listen, the reason why Twitter and Facebook created the thing called MAU and DAU was because they were trying to create a proxy for what future revenue would be. And if you didn't have an active user, then that user couldn't see ads because they were not active. They're not on the platform enough to insert an ad every 10 tweets or every 10 posts on Facebook. And so people created these monthly active users and daily active users as a proxy for that's a revenue generating unit in the future. And then we'll figure out what the average revenue is per MAU or average revenue is per DAU. And so they were proxies. And what I said to the team was, our actual product produces revenue. We don't have to add a revenue model on top of it. When someone opens a checking account and they put money into it, it's producing revenue. As long as if there's no money there, it won't produce revenue. But our proxy is actually revenue. And revenue is the monetization vehicle where the engagement metric in the old world was MAU and DAU. Our engagement metric is revenue. And the best way to measure that is actual revenue per member or revenue per product. And so I didn't want our team to think that we had to create proxies for revenue, but that revenue was the engagement metric. And then ultimately the unit of revenue would be a member or a product.
Yeah, but it was met with such skepticism, which kind of surprised me. I mean, and it hurt your stock for a time. If right, but I think sticking to something that you believed was true and is clearly playing out to be true was the right thing to do.
Anthony, you talked about a winner takes most market, but you also talked about category winners. So can you kind of help us reconcile like what you see as winners in like the horizontal digital wallet landscape? And do you see winners still existing in, let's say, like vertical niches?
I think in the horizontal sort of category, there's us, and I think there's the incumbents. Like I can't think of in the United States, a digital offering that has the product breadth that we have. I would say, Robinhood has a couple products and Chime has 2 products that we're both going after different demographic groups, but no one really has the holistic one-stop shop approach other than B of A and Citi and Wells Fargo and JP Morgan. And I'd say of that group, JP Morgan is by far the best. There have been times where I'm like, oh, they're not that good. And we've hired a couple of people from there and I've gotten to know more people there. And I'm like, they're pretty good. They're really good actually. And they're good in a sneaky way. Like I didn't even know that JP Morgan Chase offers brokerage. They have more brokerage members than we have. And it's kind of like below the radar screen. Do they do loans? They do, but only if you have a certain amount.
I have a brokerage account with Chase. It's not my main one, I can tell you that, but I do have a brokerage account and a little bit of money in there. So yeah.
Net wealth. So, the big incumbents, they're not going to go away. I mean, they have almost $1 trillion of deposits. They have hundreds of billions of dollars, but we're taking a little bit from all of them every day. And they don't even notice us because we're taking a little bit of all of them every day. I think the more vulnerable group is regional banks, credit unions, mom and pop things. And my analogy is to like Amazon. Amazon didn't go out and buy a bunch of bookstores. They just slowly took the share from the mom and pop bookstores. Now, I don't want that to happen in the banking industry. Most people, 50% of the people, when you ask them, they want a bank a mile from their house. And we want to help support those banks. But we can support them by giving them modern technology through Galileo and our tech platform. We can support them by selling them more loans so they don't have to worry about originating loans and building those businesses, which they probably can't do. And we'll help them survive and build the overall ecosystem. I do think that we can participate without putting those banks out of business in helping them survive and serve their local communities. And in doing so, get to the same scale as the Citis and the B of A's and the JP Morgans. Not to mention we're stealing a little bit of share from all of them along the way. In the category killer camp,
by the way, let me say this because I think this is important. Okay, he speaks about their, people wanting to be within a mile of their bank and those sorts of things. Okay, so my opinion is that's more of the older generation. I don't think the younger generation is going to care about that, just to be quite frank, at all. I think the younger generation, they cash is irrelevant. Like they're never going to use cash. So they don't need an ATM. They don't need to speak to a banker at a branch or things like that. So I think for the younger generation, it's just pretty irrelevant for those folks. For older generation, that's totally different. If you're in your 50s and 60s and you're used to that, you want a physical branch that's close to you. If you're younger, I don't think you even care at all. So good interview overall there. I liked a lot of the points Anthony Noto really hit on there. I think that was phenomenal. And I mean, at the end of the day, people need to just understand SoFi is a bank. It's a very fast-growing bank, and it's a very tech-focused bank, right? And so that's what differentiates it versus a Wells Fargo, a Bank of America, those sorts of guys, right? Those ones aren't obviously nearly as fast-growing. They're not as nearly as tech-focused, right? Versus a SoFi. But at the end of the day, this really needs to be thought of as a bank, a company that's acquiring a lot of customers. Those customers will grow their net worths over time. The company will be able to sell more products and services to those folks over time. And, it can be a very, very profitable business as the years tick on and go from, obviously being a money loser in the past to all of a sudden a big money maker. Okay. All right, guys, appreciate you joining me as always. Thanks so much for being here. Hope you enjoyed today's video. And also to get that workshop, it's free. Pin comment down there, folks. Enjoy that one. Alrighty, much love and have a great day.